So, REV Group just dropped its fourth quarter earnings, capping off what's been a really transformative year for them. But while the numbers look pretty good on the surface, the real story here is the massive strategic shift that's about to change, well, pretty much everything for the company. Let's break it all down. And right out of the gate, you can see the market absolutely loved it. The stock shot up almost 6% on the day of the release, and on some heavy volume, too. Now, that's what we call a strong institutional bid. It tells you the numbers didn't just meet expectations, they really validated the whole thesis. So what was driving that pop? Well, it was a clear-cut beat right across the board. In a market this choppy, execution like this really gets rewarded. They delivered on revenue, they delivered on the bottom line, and maybe most importantly, they delivered on margins. Okay, let's get into the weeds here because this is where it gets interesting. The quality of this beat is what really stands out. Adjusted EPS of 83 cents just sailed past the 78-cent consensus. Revenue came in nice and strong at over $664 million. But look at this. The crucial point is that adjusted EBITDA margin. It expanded over 200 basis points compared to last year, hitting 10.5%. That shows some serious operational muscle and cost control. But when you start digging into those consolidated results, you see this major split. This quarter wasn't a story of a rising tide lifting all boats. No, this was a tale of one segment absolutely firing on all cylinders, while the other, it was navigating some serious headwinds. And this slide just lays it all out perfectly. The specialty vehicles segment, we're talking fire trucks, ambulances, was an absolute powerhouse. Sales surged over 15%, and the backlog actually grew. Meanwhile, you look over at the RV segment, and it was basically flat on sales with a declining backlog. That really reflects cautious dealers and just a softer consumer environment. Understanding this contrast is totally central to understanding the company right now. Let's just pause and focus on that specialty backlog for a moment. $4.4 billion. That is a massive, massive number. It gives them incredible revenue visibility. We're talking about locking in roughly 2 full years of production for their fire and emergency business. In an economy this uncertain, having a backlog that durable is a huge, huge asset. The CEO's own words really frame the whole narrative here. This strong quarter, it's really the culmination of a turnaround that's been years in the making, but it also serves as the launchpad for the company's biggest change yet. And that brings us to the elephant in the room, the Terex merger. This deal has become the single most important variable for REV Group's future. It fundamentally changes the entire investment case, shifting it from a standalone operational story to a massive, large-scale integration story. So this merger is set to create a nearly $8 billion giant in the specialty equipment space. Management is talking about $75 million in cost synergies, but look at that timeline. It's not expected to close until the first half of 2026. That long waiting period and just the sheer complexity of the deal is exactly why management didn't give any formal guidance for fiscal 26. The future is all about this merger now. Okay, so let's put all the pieces together. You've got a stellar operational quarter, but it's kind of being overshadowed by this huge pending merger. That brings us to the next call, our forward-looking take on all of this. So this is the key question on every investor's mind, right? The stock has had this phenomenal run, up over 80% in the last year alone. The turnaround story is pretty well understood by now. So after this strong print, is there any gas left in the tank? Or is all the good news already baked into the price? Our rating on this is market perform. Look, we have a ton of respect for the operational execution here. It's been fantastic. But the stock's massive re-rating, combined with the significant overhang and integration risk from the Terex merger, it just creates a much more balanced risk-reward profile at these levels. A lot of that great standalone story is now in the price. So if we're neutral on the stock itself, is there a trade here? We think the most interesting way to play this is by looking at it through a merger arbitrage lens. The whole idea is to find a way to stay long on the fantastic execution in REV's core business while trying to insulate yourself from the risk of this complex merger with Terex. So here's our plausible trade idea. First, you go long REV Group. You do that to own that incredible $4.4 billion backlog and their proven margin expansion. Then, at the same time, you short Terex as a pair trade. This hedge is designed to do 2 things: neutralize broad market risk and, more importantly, protect you against the possibility that those merger synergies don't show up or that the integration just proves way harder than anyone expects. the whole structure aims to capture the upside from REV's strong operations, kind of independent of how the merger ultimately plays out.
This is not financial advice.